Welcome to our video presentation titled The Government Bond Market. Here are our group members. We shall start the presentation with the introduction.
Hi guys.
Hi Ain. By the way, I have read on the news about a government bond and I'm interested to know about it.
I think I heard about that too. Did you know anything about this bond, Ain?
Government bond market is a debt-based investment in which you lend money to the government in exchange for a set of interest rate.
That means the bond market play an important role in our economy, right?
Yes, that's right, Shafika. Other than that, there are a few objectives of the government bond. The first one is it is functioning to raise funds to be spent on a new project or infrastructure. The second one is it also acts as a retirement investment. And the last objective that I know is it can pay down the debt. That is why government often issues debt in the form of bonds to raise money.
What are the factors that affect the prices of the government bond?
I think I know the answer. The first is inflation and the second one is supply and demand. And the third factor that can influence the price is interest rate, right?
Government bonds have a few issues that arise during this pandemic COVID-19. But I think we should discuss this another time as I have to go right now.
As expected,
record supply and rapidly improving economic data to push the 10-year Treasury yield to 2% for the first time since July 2019. But bond yields, which moved inversely to bond prices, have been stayed asleep. The question is why? This is because investors continue to seek the relative safety of the government bond even as the domestic jobs can improve and new heights are set in the equity market. Andrew Brenner, the income at National Alliance Security said, markets are not playing by the projected playbook. With the employment in many instances, treasury are not going down. Buy from supply faster than expected economic growth, additional fiscal stimulus, the inflation outlook, and eventual removal of federal accommodations will probably keep investors on the sideline until the bond market to improve. Recent rise of the yield of the MGS in tandem of the global trend as opposed to the record lows since during the pandemic in 2020 suggests that the window might have closed for government and corporation to enjoy the ultra low borrowing costs across the board. The next is some analysts do expect that the post-FTSE Russell events buying on MGS to sustain, which in turn will pull down the yield.
Next, I will continue with the second issue arise from our topic, which is mortgage rates poised to rise as US Treasury yields surge. Long-term bond yields can influence the interest rate on the mortgage and other loans. The 10-year Treasury yield has risen to 1.18% higher due to the US government spending on the pandemic relief and an economy recovery as more people get vaccinated for the COVID-19. And as yields climb, the bond prices will fall. And now, the issue of rising Treasury yields in 2021 will have an impact on the mortgage rates, reducing the homeowner's purchasing power, especially if the property prices continue to climb. Compared to Malaysia, 90% of net foreign purchases are from purchasing of government bonds. From our point of view, what can we conclude for this issue is the COVID-19 pandemic has caused an extreme uncertainty in the bond market. And due to the uncertainty surrounding the COVID-19, several market players attempted to liquidate their shares. And investors, for example, have shifted from a riskier to a safer investment, while foreign central banks were selling treasuries to obtain dollars in order to control the capital outflows and the currency rates. And for the asset managers, they are looking to raise funds to fulfill the redemption.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Shafika and I will continue to the point number 3. So the 10-year Treasury yield has risen to its highest level in almost a year. The 10-year Treasury yield shoot to the higher level in over a year show a sign of optimism in an economic comeback but also a reflection of heightened inflation fear after the enactment of the $1.93 billion stimulus package. President Joe Biden signed the $1.9 trillion coronavirus relief package as Washington moved to send fresh aid this month. The package will extend a $300 per week and unemployment insurance and expand the child tax credit for a year. It will also put nearly $20 billion into COVID-19 vaccination, $35 billion into rental and utility assistance, and $350 billion into state, local, and charitable relief. If we compare the 10-year government bond between United States and Malaysia, the United States 10-year government bond has 1.352 yield, while Malaysia bond has 3.216% yield. So what is the importance of the 10-year Treasury bond yield? So Treasury security are federal government loan. Maturities range from few weeks to 30 years. Treasury securities are considered a safer investment than equities since they are guaranteed by the US government. Bond price and yield fluctuate in opposite direction. Example, if price falls, the yield will rise, and if the price rises, the yield will decrease. The yield on the 10-year Treasury note is used as a proxy for mortgage rate. Additionally, it is viewed as a barometer of investor attitude towards the economy. An increasing yield suggests the demand for Treasury bond is decreasing, indicating that investors choose higher risk, higher reward assets. And a declining yield implies the inverse. So, for the Malaysia United States 10-year government bond, we can conclude that the demand for Treasury bond is higher in US compared with Malaysia because the bond yield in Malaysia is higher than US. Thank you.
So for the conclusion, COVID-19 had a detrimental impact on the bond market, which is causing the bond market to be unstable.
For the recommendation, when buying a bond, avoid ignoring interest rate move as it has a relationship with the bond prices, not noting the claim status, misjudging the market perceptions as it is important for investors to know, failing to check the history and ignoring inflation trends. That's all from us. Thank you.